Hey everyone, in today's video, we're going to be going over 16 US restaurant stocks. We're going to be going over their valuation, their share prices, doing a deep dive into their business model, and if I think they're overvalued, undervalued relative to their peers. So this should be a really good one. Now, before getting into it, if you like this type of content, please subscribe to the channel. Definitely give this video a big thumbs up. It really helps me with the YouTube algorithm, and would love to hear your comments on the space, your thoughts on any of these individual companies or other top restaurant stocks in the US that I may have missed. Just let me know in the comments. So, before getting into the individual stocks, what I ask you to look out for in this is just some sound bites on the multiples that different types of businesses are trading at. We're going to be looking at some quick service restaurants, some sit down restaurants, some high end restaurants, some more discount restaurants. So, it'll be really interesting to get a sense for the multiples across the restaurant sector in the US. And hopefully, out of that, you may highlight one or two of these that play in a space that you like at a valuation that you like, and you can put on your watch list to learn a bit more about the companies to consider potentially a future investment in. The first stock we're going to be talking about today is Ruth's Hospitality Group. And essentially, this company owns Ruth's Steakhouse. So, just looking at their stock price over the last 5 years, they're actually down pretty big, about 37%. You see the big dip they had from COVID, obviously. They've bounced back, but still not really trending where they were in 2018, 2019. Current valuation of the company is only about $500 million. They do pay about a 4% dividend, so you're getting a pretty good dividend yield. And trailing price to earnings is about a 14 multiple. So just looking at more recent time periods. Oh, I'll come back to that. Let's see. Okay, just looking at more recent time periods. Past 1 year, we're still seeing a very similar story. Big downwards trajectory. They're expecting a big bounce back after COVID. They haven't got it clearly. But you're seeing some sporadic results trading from 16 all the way up to 20, about a 20% move there in a month, back down to 15. So this is a pretty volatile company, which is expected the smaller you go in terms of market cap. So that's just kind of a breakdown of where the company is now from a stock valuation. If we look at their business a bit more, it's really interesting to see that they own 154, or they have 154 global locations, and these locations bring in $860 million of sales. So give or take, each location is doing $5 to $6 million on average in terms of revenue. Which is really good for a singular space. So these are highly productive, obviously high revenue, but also very high cost to serve, high-end food, very expensive capex to build out these restaurants, big spaces, knowledgeable staff, the whole 9 yards on that. When we look at their financial principles, some of this is obviously a given in terms of driving organic growth through foot traffic, and then deploying money to the highest return opportunities. But you can kind of get a sense that they're really looking to prioritize the balance sheet. So holding debt of under 1x EBITDA is really, really good. They likely won't get themselves in much trouble from a debt perspective by holding that principle. And then they have had a history of returning excess capital to shareholders through dividends and share purchases. You can kind of see here on the right side of the chart each year. While a bit lower in 2020, 2021, they came back in 2022 and gave about $50 million back to shareholders. Remember, this company's trading at just over a $500 million valuation. So this is a pretty healthy return for shareholders in a singular year. Looking forward on Ruth's Chris, their earnings per share estimate for current year is about $1.30. It's the same for 2024, so pretty stagnant, trading at $16. So they're trading at about 13 times current year and future earnings. So a relatively low valuation compared to some of the other stocks we're going to be looking at. But it's important to note that this is a pretty small company in the grand scheme of things. They haven't had a great track record in terms of growth over the past 5 years. And they really do hit on more of like a business traveler, higher end consumer who may be hurt depending on what the macroeconomic environment holds. And their biggest lever for growth and margin and profit expansion is foot traffic. They're really counting on having operating leverage on their current footprint, having more people in the door to make more money. So if that goes the other way, it's going to have an adverse effect, and those earnings per share are going to go down even more. So a bit of a riskier one, and the multiple it's trading at is kind of accounting for that. Going into stock number 2, we have Restaurant Brands International. So this is a quick service restaurant stock. They own Burger King, Popeyes, Tim Hortons in Canada, and they acquired Firehouse subs. This company's been performing pretty well. Sorry, I'm going to have to refresh some of these. There we go. Plus 12% in the last 1 year. Lots of the quick service space trades at a higher multiple, is seen as more defensive than the sit-down restaurant space, especially when you're talking about, $100 dinners at Ruth's Chris versus a $15 dinner at Popeyes or Burger King. So I think that's why lots of investors value these companies at a higher pace. For the most part, these are also royalty revenue models where they have franchise fees that are coming to the corporation, and they have individual entrepreneurs running the business, which just makes it much more asset light, generally speaking, and much easier to scale the business over time. So this company, Restaurant Brands International, is trading at about 21 times earnings, pays over a 3% dividend yield. If we look a bit more on this company just to get a sense of their geographical diversification, you can kind of see here they play all over the place. They have tons of restaurants on the left-hand side here in North America. It's about 15,000, about 2,000 in Latin America, 5,000 to 6,000 in Europe, Middle East, and Africa, and then 3,000 in Asia. Now, since this slide has been adjusted back 3-4 years ago, they've also acquired Firehouse subs, and they've continued to really penetrate Europe, Middle East, Africa with Burger King and Popeyes locations. So this is even more restaurants now. I think they have about 38,000 restaurants, and they're on the road to 40,000. That's what they say their goal is. So you're also getting some geographical diversification, royalties coming in from all regions of the world, not just the United States or Canada on this one, which is definitely good to have for your broader portfolio. Looking at the price to earnings on this one, you can kind of see they're estimating $3 for this year, 10% increase after that for next year. So looking back at their share price, this year they're trading at 22 times earnings. Next year they're going to be trading at exactly 20 times earnings, essentially. So you're seeing that much higher multiple versus something like a Ruth's Chris, but this is actually a lower multiple than some of the other quick service restaurant stocks that we're going to be going through. So I think QSR is fairly valued. I actually own it in my portfolio as a disclaimer, but that's definitely one that you may want to be keeping your eye on. Third stock here, and we can try to go through these a bit quicker, is Chipotle. So Chipotle's performed really well, up 9% past 1 year, but up 400% past 5 years. So this company has really exploded after they had some of those issues earlier in the 2010s in terms of, I forget, some sort of disease or whatever being passed through the food. They've bounced back huge. This is now a $47 billion business. When we look at some of the company's Q4 numbers, in an environment that companies were really challenged last year, they increased their total revenues by 15%. They increased comparable sales growth by 8%. They had digital sales represent almost 40% of food and beverage sales. Operating margins up 11% to 13%. Diluted earnings per share, up to $32, a 40% increase. So they're just firing on all cylinders, really organic growth, but also delivering some scale as well in the numbers as we see the bottom line expand faster than the top line. With that being said, the earnings per share estimates on this company, $42 for this year, $50 for next year. When we look at the stock, even if I give them next year's earnings of $50, this is still trading at about 33 times next year's earnings. Really expensive for a restaurant stock. I get that they've executed really well, up 500%, obviously. But this one, I think, for me at least, not really wanting to buy into the long-term story of holding this for 5 or 10 years. I just think it's very well priced today in terms of valuation relative to some of its peers. So not the one that I'm personally going to get into, but they've definitely done a lot to deserve that multiple in terms of their last year's growth as well as just their executional performance over the longer term. Okay, going into restaurant stock number 4. This one is Darden Restaurants. So Darden is an $18 billion company. I believe they do sit-down restaurants. We're going to get into their brands in a minute. Trading right about 20 times earnings, 3% dividend yield. If I look past 5 years here, they're up huge, 70%. In the last 1 year, they are up almost 20%. So they've been doing really well throughout the pandemic and bouncing back. Just quickly here, their biggest brand, I think, is Olive Garden. They also own Longhorn Steakhouse. We can go through a bit more depth on this slide. Here that we're pivoting to, I think it's the next one. No, having some technical difficulties here. But on this one, I think this one's just really highlighting how they really do serve every state it looks like they're in, which is really good news. Trying to find their restaurant overview as well. I think they had it on one of their top pages. Bear with me. All right, here we go. Must have lost it. But Olive Garden, Longhorn Steakhouse, Yard House, Seasons 52, Bahama Breeze, Cheddar's. I'm not overly familiar with all of these companies. Obviously, Olive Garden, Longhorn Steakhouse, I'm aware of, but they just have a portfolio of sit-down restaurants. They may be getting a benefit of the diversification that they have in their multiple, since they're trading significantly higher multiple than Ruth's Chris. But the other thing is their business has been growing really well, and it's not just one area, it's really across the board. Kind of see Olive Garden here, which is their biggest sales segment, up to $1.3 billion. You're 14% quarter over quarter for Q3. You're seeing that double-digit growth across their fine dining portfolio, their steakhouse, their other portfolio, and that's really resonating for the most part into profit margin growth too. So Olive Garden had up 1.5 points of profit growth. Other restaurants had a slight profit growth. They had a couple headwinds in the middle there, but I think Olive Garden's the most important one for them. In terms of forward outlook, they are estimated to do $8 a share this year and then grow 10% to $8.80 next year. As we look at the share price, $8 a share, so they are trading at about a 18 to 19 multiple this year, expected to go down to kind of like a 16.5 multiple next year. My thoughts on this one is I think that feels about fair for a diversified sit-down restaurant company that has like Olive Garden as well as some fine dining, some other. They're really a restaurant conglomerate. So trading in the high to mid-teens seems reasonable. Much bigger company, much broader diversity in terms of their diversification. So much less risky than Ruth's Chris, and that's really built up a higher multiple as well as their recent performance. Next stock here is Domino's. So Domino's past 5 years has really gone on a bit of a ride all the way up to like $500 a share, over $500 a share, $560, and now back down to $330, still up 43%, not including the dividend. So they've had some slowdowns in the last year. Their multiples contracted from a mid-30 multiple to a 26 multiple. But with that being said, this company is still in a good spot overall. They're completely franchised pretty much, so they're just collecting those royalty fees. They have 6,000 stores in the US, but over 11,000 internationally. So their international business is really driving lots of the business today, but also a ton of the growth as they open up a lot of new restaurants there. And I just think having international diversification in a handful of the stocks in your portfolio is beneficial. So I look at that as a bright spot for this stock, because I feel like as people living in the US and Canada, we tend to be way overdeveloped in terms of the Canadian and US exposure we have relative to, all the other companies in the world and countries in the world. In terms of their EPS forecast, Domino's is currently having an estimate this year of about $13 going up to close to 15 next year. So if I look at their PE, they're really trading at that mid 20 multiple for this year. And then for next year, they're kind of going a bit down to like a 23 to 24. Given where other QSR restaurants trade at and just Domino's performance over the long term, which has been really impressive, I think that that's probably right where they deserve to be. I don't think they deserve to be in the 30s in terms of multiple. Same as I'm wary of Chipotle there. But I also don't think that this company deserves to be in the teens or anything like that, given how well they've grown and scaled and opened up new locations globally. So I think they're probably fairly valued where they are. You get about a 1.5% dividend, maybe not a bad opportunity to start averaging in or start nibbling in dollar cost averaging. But that's my thoughts on Domino's Pizza overall. Next one, and we'll do this one quick because I've talked about McDonald's before, but McDonald's is a beast of a company, biggest restaurant company that we're talking about here today, over $200 billion market cap. They own real estate, they own some of their own locations, they own primarily franchised corporate licensing rights that they're getting royalties and rent on every restaurant in the world. And they are trading very expensive. So up 12% in the last year, up 75% in the last 5 years. If you look at their dividend, they're paying a 2% dividend right now. But what I really wanted to look at is their dividend growth history is magnificent on this company. So as we look at, let's let this load again. Lots of links in this one in terms of tabs. So some of them just need a bit of a refresher. But as we look at their dividend history, let's just even go back 10 years to 2013, 2012. From 70 cents a share in 2012, 10 years later to 2022 and 2023 now, we're at $1.50. So the dividend's over doubled in the last 10 years. Really good compound annual growth rate of the dividend on top of delivering strong capital appreciation on the business. Now, if we look at their earnings projections for 2023 and 2024, they're coming in at $10.50 for 23 and then almost $12 for 24. So as we look at their stock price, they're really looking at like a 27 times, 26 to 27 times earnings multiple for 2023, and then closer to 24 to 25 for 24. Sorry, lots of numbers there. But at the end of the day, love the company. I actually own McDonald's. I'm up huge on it, but it's a tough one to add to. I think it's probably fully valued given the space they play in, how much they've already leveraged their moat. Ultimately, I think this is a company that will do fine no matter what it is because it's so defensive and they stand for value. Also have a huge American business, but also a big international business and have great equity around the world. But you're definitely paying up for it. You're not getting a steal on this stock. So just be wary of that if you are evaluating a position in McDonald's. Okay, going to the next stock today, which is Wendys. I did a 40-minute stock analysis on Wendys separately. So if you're interested in that, just find it on my channel. But Wendys overall, pretty small company, only about a $5 billion company. They primarily play in the US. They are trading at a 25-ish multiple, it looks like. They just doubled the dividend to 4.6%. This company does have a good amount of debt on it, which is one of the reasons in my video that I wasn't too bullish on the company, especially because they were trading at the same multiple as some much less levered companies. But their strategy is really in line with lots of the other quick service restaurant strategies. They're trying to deliver same retail store growth. They're trying to accelerate their digital platform and obviously their footprint expansion. Mostly international is what they're looking at. They're looking at waiving some licensing fees for startup entrepreneurs so they can get their capital and their investment back quicker, just to make opening up a Wendys look more lucrative than other options. So, that's a good strategy for the long run, but won't really help them in the short run. It may actually hurt them as they have to incur costs and capex to help those businesses operate without an investment or without a return on the shareholder side in the medium term. But overall, my general opinion is, as I listen to their earnings report and stuff like that, it seems like these are just obviously poor KPIs and things that quick service restaurants have been doing to win over the last 5 years, really focusing on same store sales growth, really driving scale on digital, and obviously selling like heck on opening up new franchisees around the world. And it just seems like Wendy's is like just 2-3 years behind a company like McDonald's on this stuff, and probably losing share behind it. So wasn't one that I was overly excited about. As we look at the valuation, they're trading, or they're expected to do about $1 this year, $1.10 next year. So as you look at their share price, we're talking about 22 times earnings this year, 20 times earnings next year, if that holds true. For those prices, I much prefer buying a Restaurant Brands International with Burger King, Popeyes, Tim Hortons, Firehouse subs. Much better track record, much better allocation of capital, in my opinion. And I'll just leave it at that. If you want more information on Wendy's, be sure to check out that video on my channel. Going to the next stock here, it is Shake Shack. So Shake Shack is a $2.3 billion company. As we look at the stock over the last 1 year, it is down 10%. So a much different story than some of the other quick service restaurants we've talked about today. Past 5 years, up 26%. So it's just been dipping since midway through COVID, it appears. Lots of competition in this space, so it's not necessarily as the space goes up, everyone goes up. As we look at some of their glide paths over the past couple years, it looks like their revenues had a pretty nice uptick, system-wide sales up, digital sales really ticked up to the 40s, now in the mid-30s, still not bad in my opinion. Weekly sales has been pretty stagnant over the last 2 years. That's a bit concerning with how much inflation has gone up, and probably their cost to serve those consumers has gone up. Operating profits, 16, 17, 18%, and then system-wide store count has continued to go up. I guess that's a good sign, at least on that end. With that being said, this company is not really profitable. They're expected to essentially break even both this year and next year. So in an environment where interest rates are 5-6%, and the opportunity cost of putting your money somewhere is really high, I just find it really challenging to invest in a company in an established space that's been around for a while. Shake Shack's not the new kid on the block necessarily. That doesn't have profit this year or next year, no ability to really return value to shareholders via share buybacks or dividend. So this is one because of that, and because of that alone, that I just think there's better opportunities, and I'll be focusing on those out there. Going to the next stock here, it is Brinker International. So this is a $1.6 billion company. Looking at the stock over the past 5 years, they are essentially flat, but that doesn't come with no volatility, as you can see by the chart. And then in the last 1 year, we're seeing about a 10% uptick. So that's pretty standard. That's the general trend I'm getting for the space right now. Definitely outperformed the market in the past 1 year. As this page loads, we kind of get a sense for some of their brands here. So Brinker International owns Chili's, owns Maggiano's Little Italy, owns It's Just Wings, and then a Maggiano spinoff. I'm not overly familiar with these restaurants because I sit in Canada, for those of you who didn't know, but they seem like they're at least pretty diversified in the areas they play. They have an Italian restaurant, they have a wings business, they have a chili restaurant. So some diversification, at least, in their revenue streams. The second thing I just wanted to look at was their results. So they're driving decent growth here as we just look at their last quarter, up about 10-11% on company sales. Same on revenues. Operating incomes was essentially flat because of all the cost increases. But as we look at the net income per share, slightly up about 3-4% on net income per share, and then diluted net income is about 7-8% up. So they're performing okay, I'd say. As we look forward, this company is expected to do about $2.30 this year, $3.60. So a huge jump next year. Not exactly sure what's behind that. But as we look at their stock, that pretty much means they're trading at 14-15 times current year projected earnings, and then about 11-12 times next year. So that's a pretty big difference. I'm not sure what lies between that, but I feel like this company, assuming the balance sheet is similar, probably deserves to trade in a similar spot as Darden. They both have about low double-digit revenue growth in the trailing period. They both have a pretty diversified set of restaurant brands nationally in the US and operate in sit-down restaurants. So it looks like Brinker is a bit cheaper. Not sure if there's reasons behind that, once again, balance sheet or otherwise, but maybe something to take a second click at after this video. The next stock I'm talking about today is Yum Brands. So Yum Brands, that is the business that owns KFC, Taco Bell, Pizza Hut. Pretty big company, $37 billion, pays about a 2% dividend. This company's been pretty flat, I believe, over the last little bit. I remember looking at this company a while back at about $125, but it does seem like they did dip and then go back up. So about up 10% on the year. Looking back 5 years, this company actually is up 50%. So they have outperformed over the last 5 years, which is nice to see. In terms of their specific, kind of see same-store sales growth is pretty strong across the board. Specifically at KFC, 5%. That's decent, especially unit growth 3%. And then Taco Bell up 11%. Pizza Hut is an interesting one. You see their same-store sales up 1%, units up 4%. So in a world where costs have gone up, I'm shocked to see units outpacing sales growth at Pizza Hut. With that being said, Pizza Hut has, I believe, been the dragger of this company over the last number of years. Tons of competition in the pizza space. No one's really going for sit-down pizza anymore unless it's like gourmet or premium. So they've really had to reinvent that business, and that's taken time and really impacted the stock longer term. Overall, I'd say these are decent results for the type of business that it is. Very stable business. At least they're delivering growth, specifically on Taco Bell. That's great to see. As we look at their earnings per share, looks like they're at $5 this year, $6 next year. So looking at their stock price at $5, the company's trading at about a 26, 27x earnings. And then for next year, trading at about 22, 23. So, somewhat similar to McDonald's, a tiny bit less expensive than McDonald's, but essentially in that same ballpark in terms of the valuation you're expected to play. So my thoughts on this one are similar to McDonald's. I think these companies are fully valued for sure. And in a world where I already own one fully valued quick service restaurant and McDonald's owns the real estate, I think they own the best brand in the space. They stand for value the most. That's the one that if I had to be in one, I'd rather be in. So I'm sticking with McDonald's. Yum is a fantastic business. Just not room for it in my specific portfolio right now. Going on to Denny's. So Denny's, once again, similar to Ruth's, I was surprised to see how small a company Denny's is. Only about $600 million market cap, trading under 10 times earnings, it looks like. Looking at their stock chart for 1 year, down almost 20%, 5 years, down over 30%. So this company's really been in a downfall. Looking at some of their investor slides, you can really see they're pretty well diversified, but they do have the majority of their units in California. I think this is Texas, Florida. Is this Arizona? Probably Arizona. So you can really see that they're more focused in the South for sure. Yeah, that was Arizona. I got it. The second thing just to note is they also looked like they either opened up or acquired a restaurant called Kiki's. Looks like a more premium breakfast place in Florida. Has 54 restaurants in the Tampa Bay and Orlando region. They're kind of showing it off. It looks like it's been doing pretty well, and they're trying to franchise out more and more. They're kind of comparing it to Denny's year over year in that area as well. So something to note, you're not just owning the Denny's brand, you're also buying this Kiki's business that primarily operates in Florida. For those of you in Florida, if you know more information about it, let us know in the comments. I've never personally been there. In terms of their earnings outlook, 60 cents this year, 70 cents next year. So as we look at their share price, they aren't really trading, at least in terms of the analyst estimates, at 8 times. Next year, they're going to be trading at about 14, 15 times. probably more in line with what they deserve, closer to like what a Ruth's Chris is trading at, since it's sit down, and plays in maybe a bit more of a discretionary space in terms of people needing or wanting to go out for breakfast. So I think that's probably a fair valuation as long as they continue to execute. Probably some more downside. What I would say is I think they launched a pretty big share buyback plan, which is returning a lot of shareholder value back. So I take a look at that if you're looking at investing in this company. Just if you need another reason to push you over the top, consider what that buyback plan is, because that'll really help you increase your share of the company, only assuming if their balance sheet is in a good position and they're able to do so responsibly. The next stock here is Jack in the Box. So Jack in the Box, another one I thought was a bigger company, but only about a $1.8 billion company. Pretty flat over the last 1 year, over the last 5 years, also very flat. So this company really hasn't gone anywhere, trading at about 14 times, 2% dividend. Looking at some of their investor slides, they primarily operate in certain states as well here. So it looks like Texas, Kansas, Illinois, and then on their Del Taco brand that it looks like they acquired, it's more on the east side of the U.S. So Florida, upwards a bit. I think this is Michigan. So they don't really play in the very north area of the U.S., which is interesting. Maybe they'll get there eventually, or maybe there's a strategy behind that. But this company also owns Del Taco as well as Jack in the Box, just to make that super clear as we go through this. They're really looking at driving further reach of their brands. But what's really interesting to see, and one of the reasons the stock probably hasn't gone anywhere, is you can kind of see year over year, while they're opening up locations, it looks like they're shutting down more than they're opening. And if you look at the net change in restaurant count, it's generally been trending down over the last few years. So not sure if they need less stores to make the productivity of their current stores better, or what the story is there, if the economics aren't working for franchisees or whatever it may be. Unfortunately, seeing the same tale over the last year with Del Taco, even though they've had a much better track record prior. And then lastly, just looking at restaurant volumes, you can kind of see it slowly tick up, which I think that's a healthy run rate increase. It's just with inflation going up as much as it is this enough? Is this enough to hold profitability, to make sure they can keep reinvesting in their business? The same store sales growth at both these companies are a bit all over the place, especially at Jack's here, down to almost nothing in 2022. Del Taco performed a bit better, but they had some weak years here as well. So not the most consistent fast food business you'll see for sure. And then lastly here, it looks like they're estimating $5.50, give or take, of EPS for 2023, while the street is expecting rather a bit higher, about $5.90, and then about $6.50 for the next year. So if we're going to look at the stock here and assume they're going to do $5.50 to $6 a share, even if I give them the benefit of the doubt, give them high side $6 a share, that is about 15 times earnings today. So not really much growth to what their trailing EPS number was, it appears. And, as you see the volatility on their store count, their inability to really grow top line at a high pace, you can kind of see some of the challenges they're having here versus some of the other companies that we've recently looked at that are growing a lot more seamlessly on some of those indicators. So I think given they're in that quick service restaurant space that technically or generally deserves a premium, there's a good reason why they're down here in the mid-teens, and you see Yum Brands and McDonald's in the high 20s. So I think this is probably where it should be. Not a company that I really want to touch because I'm not sure they have a proven growth model yet. But for those of you who are interested, you're definitely getting a better valuation in terms of earnings multiple versus some of the other fast food companies. Moving on to Bloomin Brands. So Bloomin Brands, $2 billion company, pays about a 4% dividend, up 20% in the last year, but only up 6% in the last 5. So it's really broken out here in the last year. In terms of brands that Bloomin Brands owns, they own Outback Steakhouse is probably their biggest one, Carrabba's Italian Grill, then Fleming's Bonefish Grill, Aussie Grill by Outback, obviously, and then Bloomin Brands International. Guess that's a separate restaurant. So this is like similar story to Darden. Some of the other Blinker was it? Some of the other companies we saw that are just these sit-down restaurant conglomerates. As we look at their earnings per share estimates on this company, they're coming in at about $3 this year, $3.10 next year. Sorry, I lost my voice there for a second. So this company actually, if those EPS numbers are correct, looks like they're trading pretty cheap, and that may be why the company's run up here. They actually deliver $3. This company's trading at about an 8 to 9 times earnings multiple for this year and next. So this one may be worth doing a bit more digging on. Maybe there's some one-time items in there, but it looks like it's trading relatively cheap versus the other sit-down restaurants that were more like low to high teens, depending on their recent performance in their businesses. The next restaurant stock here that I didn't even know was a public company until doing this video, but Nathan's Famous Hotdogs. You guys may know them from sponsoring the hot dog eating competitions that go viral every year. They also have lots of like stand-up shops and stuff like that. But this is a $300 million market cap company, up 50% over the last 1 year, but flat over the past 5 years. So another one of these that have really just run up recently. They do pay a little dividend. They do trade for a mid to high teens multiple. Just looking at their financials here, they really had not great financials in terms of top line. So increased by 1% in the fourth quarter. Operating income, though, grew a lot higher. So they were able to pull other levels on their business. Not sure if they pulled back on marketing or whatever it may have been, but they really drove EPS significantly higher than the year ago period. And they increased their dividend accordingly as well, which was good for existing shareholders. No analysts currently cover the stock, so it's no EPS estimates. So be careful with this one, but it is a pretty small market cap. They obviously have a famous brand, and I think this one's just cool that it's public in general. The next stock here, big company, or not big company, but pretty famous restaurant stock, Cheesecake Factory, trading at $1.7 billion. Over the last 1 year, this company has essentially been flat, down about 5% or so, most of that in the last few weeks. Past 5 years, bear with me, down about 35%. Once again, not flatline down. They ran up huge after COVID as people flooded their restaurants, now back down to $33. Pays about a $3 or 3% dividend rather. Looking at some of their slides, they own, it appears, lots of their stores in the North American market, but then they license internationally and just collect some royalty income. Mexico City, Monterrey, Kuwait, Saudi Arabia, Beijing, Shanghai, Hong Kong has some locations, it looks like. So the vast majority of their revenue and earnings are coming from North America. Within that, probably the US. But they do have a bit of income coming in from other regions of the world, and that may be a future growth expansion opportunity. This was interesting to see just as we look through this whole category. We've gone through lots of these in terms of Chili's, Olive Garden, Carrabba's, Longhorn, Outback, all of these ones here as well. So you can kind of see the average check that some of these businesses that we've reviewed in terms of their stock play in. So Cheesecake Factory is, call it middle end, but then on unit volumes, they're significantly higher in terms of the amount of units they're cranking out. And that's really what they're communicating to the street here, that they're a reasonable check size, but they're just cranking people in and out of these locations. Really effective and productive space. In addition to that, they've really focused on diversifying their business and really testing and experimenting. So, this can be seen a couple different ways. They probably ran out of growth domestically on Cheesecake Factory. They're looking for other levers to take a bite out of the restaurant space, no pun intended. This may also be distracting people or distracting internally in terms of focus and where they should be innovating and looking for growth. So different people look at these kinds of strategies differently. Whatever your thoughts are, they are doing a lot of work here on diversifying in experiential options in terms of the types of restaurants. Some of these look like they're more quick service. Some of these are obviously sit down. Some look super premium. Some look Italian. Some look like steakhouses. Excuse me. So lots going on here. The vast majority of the business is still the Cheesecake Factory. So just know that. But if you pass any of these restaurants, know that the Cheesecake Factory stock does also own them and give you equity in those as well. This is just looking at some of the performance. So you can kind of see here, Cheesecake Factory, it's grown 11% in the last 3 years. But North Italia, which is one of their new Italian concepts, has grown significantly more. And then some of their more experiential restaurants, once again, has grown significantly more. If we just look, I'm just looking here, trying to compare. So it seems like while not growing as fast, Cheesecake Factory is still significantly more productive than the other methods, or concepts rather, which isn't surprising given the brand name and how much people love the Cheesecake Factory that go there. So this is just breaking out where they're looking at potential growth on their biggest opportunities versus just their boutique brands that they're building out here. Really just to show how they're focused on using these new brands as just incubation engines for innovation. Maybe if they see something that works well, they'll look at integrating it into Cheesecake Factory in terms of just, commercialization of menu items or price points or whatever it may be. But I think they're really looking for their next layer of growth on top of Cheesecake Factory. That's their main objective for these new restaurant concepts that they're testing out. And lastly, I found this to be interesting as well, just as we look at the long-term growth target. They're really thinking of Cheesecake Factory as kind of the cash cow, stable growth, but North Italia and the other concepts, I forget what they referred to them to, the Fox something concepts, Fox Restaurant Concepts, FRC, as the main growth engines in terms of units. So up 20%, 15 to 20% with Cheesecake Factory just growing a couple percent a year. It's really interesting here is you can kind of see the CapEx for a Cheesecake Factory, $8 million versus just $4 million for North Italia. They don't really give it for this because it's so many different concepts wrapped in. And then cash on cash returns, they're expecting higher cash on cash returns given the lower CapEx on some of their new concepts. So after all of that, going into the valuation. So $275 this year, $330 next year in terms of earnings per share. So they're currently trading at about a 13 times current year earnings and then about a 10 times next year earnings. So this one, honestly, given the strong brand of the Cheesecake Factory, if those earnings per share numbers are accurate and they have an okay balance sheet, this may be one that would be an interesting stock. You get a 3% dividend, you get the strong brand and the cash cow that is the Cheesecake Factory, and then you also get a piece of what they're trying to foster and grow in terms of all those incubator restaurant brands as well. So this is actually a pretty attractive option, in my opinion, within the sit-down restaurant space. And I may actually add this one to my watch list to keep an eye on it. The last stock that we're going to be talking today is Texas Roadhouse. Texas Roadhouse has done so well over the last number of years, up 80% last 5 years, up 35% in the last year. They've been cranking their dividend payments up. They're a $7.5 billion company. If we just look at their earnings per share, $4.70 this year, $5.50 next year. So huge growth anticipated for this company. Even if we give them the benefit of the doubt and give them the $5.50 number, this company would be trading at just around 20 times next year's earnings. And if I look at this year, they'd be trading at about a 24, 25. So really expensive for a sit-down restaurant to be trading at a 24, 25, looking at the multiples we've seen here that go anywhere from 10 to high teens. But they've really driven a lot of growth on this business. If we just look at their numbers here, year over year, going from 2.4 billion to 2.7 billion, COVID 2.4, up to 3.5 in 2021, and 4 billion in 2022. So they've almost doubled the business from pre-COVID. And then on net income, up to $270 billion, an extra $100 million on that from 2019. So they've executed really well Apparently, Texas Roadhouses in the US are always packed. I've only been once and it was absolutely slammed. There was a line out. So they really have a winning concept, it appears, and they have a lot of runway to grow, expansion of restaurant counts. They can probably price if they wanted to. They have a lot of pricing power and a lot of levers to just drive profit ahead of revenue growth in the years ahead. So this is one that great business, similar to Chipotle or Yum Brands. Think the business is great. Think it'll continue to outperform and grow market share. But I just think there is better options in terms of valuations, which I tend to lean towards. So those are my thoughts on these 16 restaurant stocks. Guys, it was a ton of work to put this together. So if you're still watching this video, please let me know in the comments. Would love if you hit that like button. Also, please subscribe to the channel for more content like this. I'd really appreciate it. Thank you guys for watching this all the way through, and I'll see you guys in the next one.